Following facts are for a non-cancelable lease agreement between Hebert Corporation and Russell Corporation, a lessee. Inception date, July 1st, 2020. Annual lease payment due at the beginning of each year, starting July 1st, 2020. $20,000 and $20,066.26. Bargain purchase option at the end of the lease term, reasonably certain to be exercised by Russell, $4,500. Lease term, 5 years. Economic life of leased equipment, 10 years. Lessor's cost, $60,000. Fair value of asset at July 1st, 2020, $88,000. Lessor's implicit rate, 9%. Lessee's incremental borrowing rate, 9%. And we're also told that the collectability of the lease payments is reasonably predictable, and there are no important uncertainties about costs that have not yet been incurred by the lessor. The lessee assumes responsibility for all executory costs. Both Russell and Hebert use IFRS 16. And the first thing we're asked to do is to calculate the right of use asset and lease liability. So why would we jump into calculating a right of use asset? Well, under IFRS, the only exemption from the right of use asset methodology is if it's a low value, which clearly it isn't because the lease payments are $20,000 and $20,066, and it's a 5-year lease, so it's not short term. So the two exceptions are low value or short term, neither of which are met here. Therefore, we know we're in a right of use asset methodology. So to calculate the right of use asset, we need to calculate the present value of the lease. So the first thing we need to do is make sure we have begin mode on. And these are going to be the inputs for our present value calculation. So we've got N of 5 and I of 9. If we look back in the question, it's a 5-year lease and a 9% interest rate. We would always use the implicit rate for IFRS, so it's 9%. We've got the payment that we're going to enter is the lease payment, $20,000 and $20,066.26 right here. And it's a cash outflow, so we're going to make it negative. And this negative $45,000 as the future value is the bargain purchase option in the question. So you can see here it says there's a bargain purchase option at the end of the lease term, reasonably certain to be exercised. So what's going to happen for the lessee is at the end of 5 years, they're going to need to make one final cash outflow of $4,500 to obtain the rights to the title to the equipment. So the way we do that for our present value calculation is we put that in as a payment at the end of the lease. So at the end of the lease in the future, we're going to pay out $4,500, and that's why it's negative. So if we put all of these inputs into our financial calculator, and there is a separate video on how to put begin mode on if you're struggling with that, and push compute present value, we're going to get $88,000. So that is the present value of the lease, the minimum lease payments. And that would be the right of use asset and the right of use liability. So discuss the nature of this lease to Russell Corporation. We already did that. We said it's not low value or short term, so it's a right of use. It's a right of use methodology lease. Discuss the nature of this lease to Hebert Corporation, the lessor. Now this is more interesting. We haven't gone through a lot of examples for lessor accounting. So this is the criteria for lessor capitalization to figure out if it's a capital lease or an operating lease. So one of the following criteria have to be met. There has to be transfer of ownership at the end of the lease. And in this case, there is a bargain purchase option. So this criteria is met. There is reasonable certainty that ownership will transfer at the end of the lease. The next criteria is whether the lease term is a major part of the economic life of the asset. Now, IFRS doesn't give us any numerical thresholds, but ASPE does. So a lot of the times for IFRS, we still use the ASPE thresholds, but we recognize in IFRS that those are not specific to the standard. It just says a major part of the economic life, so it's open to some interpretation. And this is a 5-year lease, 10-year economic life, and I'll show you where that is in the question. So this is only 50. So this criteria I would say is not met. That's not a majority, 50%. And here is where I saw the economic life of the leased asset. You can see 10 years there. So the lease term is 5 and the economic life of the leased asset is 10 years. And the next one says the lessor recovers almost all of the investment and earns a return, which ASPE says the present value of the minimum lease payments is greater than 90% of the fair value. Well, we know the present value of the minimum lease payments is $88,000. Now, what's the fair value of the equipment? Fair value of asset at July 1st, 2020 is $88,000. So it's 100% of the fair value. Oops, 100% of fair value. So met. So we definitely have a capital lease here because we only needed to meet one criteria and we've met both. However, before I actually state that, we do need to check these additional criteria because both of these need to be met. So, and both. So the credit risk associated with the lease has to be normal and the unreimbursable costs have to be reasonably estimated on the part of the lessor, those that will affect the lessor. And so here it says the collectibility of the lease payments is reasonably predictable and there are no important uncertainties about costs that have not yet been incurred by the lessor. So we know that these criteria are met, and met. So we definitely have a capital lease. Have a capital lease for the lessor. And even though we're under IFRS 16, we're still using the word here, capital lease. So now we need to look at this here. So now we need to figure out if this is a manufacturer, dealer lease, or a financing lease. So the way that we figure that out is we figure out if the initial investment by the lessor in the equipment exceeds the exceeds the present value of the minimum lease payments. So if we say the present value of minimum lease payments is going to be $88,000. So that's how much they're going to make on the equipment itself, or and then the fair value of the asset. Where are we here? Where's the cost? The lessor's cost here was $60,000. Lessor's cost was $60,000. And so because the minimum lease payments exceed the cost, this is a manufacturer dealer lease. And that's because there is profit on the lease right here. So normally if these things matched, if the present value of the minimum lease payments was the same as the lessor's cost, then they would still earn a return throughout the lease as they received interest income each year. But here they're also making a profit on the equipment, or the present value of the minimum lease payments. So it is a manufacturer dealer lease. Okay, so what's next? Next, we're asked to prepare an amortization schedule for the lease obligation for Russell Corporation. So who's Russell again? So Russell is the lessee. So we're preparing a lessee lease amortization table, which we can definitely do. So let's go back here. So we're going to have, okay, lease amortization. We're going to have date, annual lease payment, plus BPO. Then we're going to have the interest expense. Then we're going to have the reduction of the lease liability. And here we're going to have the carrying value of the lease liability. So what we're going to do here, now this is kind of a nuance with amortization schedules, and we've gone over this in some other videos, but it's still something that I'm getting used to, is we put in the date. So we're going to have July 1st, 2020, and we're going to put this in 2 times. So we have 2 of July 1sts, and then we're going to have July 1st, 2021, July 1st, 2022, July 1st, 2023, July 1st, 2024, and then we're going to have 6/30/2025, which is the end of the lease. And so we put in the present value of the lease liability, which is what we calculated above, okay? And then the first thing that's going to happen, remember how the lease payments are due at the beginning of the lease? I think this is 20, yeah. The lease payment's due at the beginning of the lease. So we're going to put in our first lease payment here. And remember, our lease payment is $20,066.26. And remember that there won't be any interest expense on the lease at the beginning of the period because it's day one. So there can't be any interest that's accrued on the lease yet, right? So we're going to end up with so this is a blank, the lease liability is going to be reduced on day one by the exact lease payment. And this is where we would usually have in our entry. You know how our entry is debit right of use asset? Actually, let's do that because we have to do it later in the question anyway. So the journal entry on inception, the lease is going to be debit right of use asset, which is going to be 88,000. That's what goes on to our asset side. And then the other thing that's going to happen is we're going to pay out cash. So we're going to pay out 20,066.26 in lease. And the balance of our entry is going to be the lease liability. Okay, so this amount minus this amount is going to give us, what did I do here? 20, I think I added an extra zero here, is going to give us 67. I think I put in this lease payment must be wrong. Here we go. This is going to give us 67,934, which is this exact amount. So it's the same concept here where this is the original value of the right of use asset and liability. But when we make our first lease payment, because it's on day one, there's no interest. So it simply reduces down the lease liability in the sense that it's the balancing entry. Same concept. The key is to remember that you don't have any interest expense on day one, because normally with bond amortization schedules, we're starting right away because those payments are due at the end of the period. But again, this is a nuance because these payments are due at the beginning of the period. So when we get into the second lease payment, and so these are all going to be the same. But what's going to happen at the end of the lease? Well, we know we only have a payment of $4,500 for the bargain purchase option. And here, this is going to be at our implicit rate, so 9%. So I'm going to have this amount. Sorry, actually, it's the carrying value of the lease liability times 9%. It's going to give me my interest expense. And then this is going to be the lease payment minus the interest expense is going to reduce the lease liability because each lease payment has principal and it has interest. So we only reduce the lease liability by the principal component, which is the difference between the two. And then this is simply going to cover. So because I'm in Excel here, I can just drag these payments down. And I definitely want to fix the rounding here. Oops. Okay. So there we go. So now I've got, I'm going to pull it down one more. There we go. And now we're at 0, which is exactly what we want. So at the end of the lease term, our lease liability needs to be 0. And that's why we're bringing it down. At the end of the lease, we'll have paid back everything. Okay. So there we go. That's our amortization schedule. And let's take a look back what we need in the questions. So we did discuss the nature of the lease for the lessee. We discussed the nature of the lease for the lessor. We prepared an amortization schedule. And now it says prepare the journal entries to reflect the signing of the lease and to record the payments and expenses related to this lease for the years 2020 and 2021. Russell's accounting period ends on December 31st. So there's a huge nuance here. So their accounting period ends on December 31st, but this lease is July 1st, I think. Sorry, July 1st. It was signed on July 1st. So we need to be really careful when we're doing our entries here. Otherwise, this seems so simple. We could just rattle it out, but we really need to be careful. So let's take a look at what that means. So we've got this entry already on the inception, and that's correct. Now let's do our year-end entry. So December 31st, 2020 year-end entries. And so we always have two year-end entries. The first one will be interest expense on the lease liability. So normally we would say, okay, so we're going to have debit interest expense, credit lease liability, and we're going to take this amount right from our schedule. Normally we would take the amount straight from our schedule here. And that would be the amount. But you can see, even just from taking it from our schedule, we can see that this date is July 1st, 2021. But we're actually only at December 31st, 2020. So we don't have a number here for 2020. So clearly we need to make some adjustments. So what we need to do is say, but only 6 out of 12 months, because we're at July. So we've got July 1st. So we've got July, August, September, October, November, December. So that's another 6 months. So what we're going to do is we're going to take that amount from our schedule. I'll pull this up so you can see the formula here. And I'm going to multiply it by 6 over 12. Okay. And I'm going to adjust that amount down. So what I've done is I've taken the 2021 number and I'm just saying out of 6 over 12. So that's going to give me 3057 as my interest expense. And then my next adjusting entry is always depreciation on the right of use asset, right of use asset. So normally I would have debit depreciation expense and credit accumulated depreciation, right of use asset. And I would say, okay, so my right of use asset is 88,000 from right here. And this is a 5-year lease. So actually, I think it's a 10-year lease. Let's just double check. What's the term? Lease term 5 years. Okay. So even though the lease term is 5 years, we're actually going to depreciate this asset over 10 years. And why are we going to do that? It's an interesting nuance, and that's because there's a bargain purchase option that's expected to be exercised. So normally we would always amortize the right of use asset over the term of the lease. However, in this case, we're certain that us as the lessee, Russell, is going to take over this, that we're going to take title at the end of the asset. We're told that this bargain purchase option is reasonably certain to be exercised. So now, rather than using the 5-year lease term as the depreciation period or the life period, we're going to use the economic life of the asset. So we're actually going to amortize this asset over, what am I doing here? So we're actually going to depreciate this asset over 10 years, okay? Which is so that's a really important nuance. So because of the BPO, we amortize the right of use asset over the economic life, not the lease term. Okay, and that's a really important thing to remember. So we're actually amortizing this over 10 years. However, we only have 6 out of 12 months to amortize. So we're going to take this number as our depreciation expense, and we're going to multiply it again. Whoops. We're going to multiply it by 6 over 12. And 4,400 then is going to be our depreciation expense. And we're going to put this in here as well, 4,400. Okay. Not too sure why that got so big. There we go. Okay, so now we've got our year-end entries. So what's the next event in the lease? Well, on July 1st of each year, so July 1st, 2021, we need to make a lease payment. So we're gonna have debit, lease liability, credit cash, and this is just gonna be for our exact lease payment, which is gonna be for 20/066/26. And same thing here. Okay, so we're going to make our lease payment. So that's pretty straightforward and always goes to debit to lease liability. So it's actually decreasing the lease liability on our statements because it's a credit balance and we're crediting cash. So now what else is going to happen? Well, what we need to remember is that up here we had only recognized 6 months of lease liability, of interest expense and depreciation expense. So now we need to top those up. Depreciation expense, we can simply top up at the end of the year, but the interest expense on the lease liability, we should recognize now. Okay, so we're gonna have our other portion of the lease liability. So other 6 months, remaining 6 months of interest on lease liability. It's going to be debit interest expense and credit lease liability. So we're going to say this is going to be the exact other 6 months. So remember how we had used this number before and we had said times 6/12. It's the exact same. So we're going to use that same number down here again. Just ignore my rounding. I would just take out the cents there, but that's the entry, okay? Okay, and then at December 2021, December 31st, 2021, we're going to have our year-end adjusting entries. So we're going to have interest expense. So we're going to have our another 6 months. Same thing we've got here, debit interest expense, credit lease liability. And this is going to be our next year now. Remember how before we took in our amortization schedule, we took the 2021 number. Now we're taking 2022, even though we're at December 31st, 2021. And we're going to multiply this by 6/12 because it's still a half of a year. And this is going to be our interest expense here. Let's just get rid of those. Let's get rid of those annoying rounding issue there. Let's go. Okay. And then what else are we going to have? We're going to have 2, which is going to be our depreciation expense. So we're going to have debit depreciation expense and credit accumulated depreciation right of use asset. And here we're going to have an entire year here because we didn't record this at July. We've just decided we're going to record it at year end, which is fine because all we need is for this to be correct for the fiscal period. So we're going to have $8,800 here as our amortization for the right of use asset. All right, and that takes us through to the end of this question. Let's just recap, take a look what we did here. So we recorded the journal entries to reflect the signing of the lease agreement and to record the payments and expenses related to the lease for 2020 and 2021.